liquidity. We're going to talk about the cash conversion cycle from purchasing to sales to receiving cash, and of course, somewhere between purchasing and sales is paying for that purchasing. So, from your cash out to cash in, what is the cash conversion cycle? Liquidity means how liquid is your balance sheet, what percentage of your assets are easily convertible into cash, and how does a company manage that liquidity and its requirements for working capital. Now, of course, you have a certain fixed capital in the business, which is your fixed assets, property, plant, equipment, and then you have your working capital, such as the account receivable that you have, the goods that you have supplied on credit, or the services that you have supplied on credit to your customers and you're waiting to receive the payment from them, or the amount of money you have stuck up in inventory that you haven't even sold this yet, you've just produced it or you've bought it and you're waiting to sell it. So that is your working capital, and every business of course needs to manage its working capital. It needs to manage its liquidity, because if it runs out of cash, then it won't be able to continue doing its business. So first we're going to understand what is a business's cash conversion cycle. How do we calculate it? How many days does it take for them to get its cash back? So from its cash out to its cash in, how many days does this take? Then, worst case scenario, if they run out of money, what will happen? What are the sources of liquidity? Primary and secondary. Primary being the good ones, secondary being the bad ones, which you can sort of think of as a backup source. How does an analyst evaluate a company's liquidity position? And I can tell you from experience that liquidity can sometimes be more important than profitability, because in times of crisis you might be a very profitable company, but in times of crisis, if you run out of cash, then you are unable to continue operations and you have to declare bankruptcy. And it doesn't matter how profitable you are as a company, if you're not going to be able to be a going concern, then all that profitability is not going to matter. And various times what we see is that companies compromise their liquidity for profitability, but that is not a good approach. So what we are going to look at in this learning module are the three different approaches, which is aggressive, moderate, and conservative. And I am of course more inclined towards moderate and conservative as opposed to aggressive, because aggressive approach will try to improve its profitability, and that comes at the expense of liquidity. And we have so many examples. Even if we talk about financial services, the example of Lehman Brothers from the 2008 financial crisis is a typical example where they tried to improve their profitability at the expense of liquidity. So, which approach you choose, whether the aggressive approach or the moderate approach or the conservative approach, what is the impact that approach has on the funding needs of a company? So, we will look at that as well. Now, let's focus on the cash conversion cycle. And I'm going to draw a small diagram over here, which will be repeated later on, but I'm going to draw it right in the middle so that it helps you draw a mental map, and then you start filling in the colors in that. So every company of course starts with purchases of raw material, or directly if it's just a trading company, then it will be purchasing finished goods directly. If they are not doing any manufacturing, if they are not doing any value addition, then they'll just purchase finished goods and sell them. Or if they are a manufacturing company, then they'll purchase raw material. Now, what's important to understand over here is that you don't necessarily pay advance cash for this. It's very much likely that the payment that you will make for these goods is going to be a few days later. For mature companies, that is usually the case. Initially, when you're starting out business, it is very likely that you might have to pay cash upfront, or you might even have to pay an advance payment. But normally, companies that analysts are analyzing are relatively mature, worth investing in, and therefore usually they are at that stage where they are getting their materials on credit, and there is a certain number of days until they have to pay for that purchase. Then this inventory stays on the books of this company until it is sold, until the inventory is sold to customers. And then usually customers also don't pay upfront, they pay a few days later. So this whole cycle between cash out to cash in, right, this whole cycle is what we are interested in, and this is what we call the cash conversion cycle, that you paid money and then you got it back. And that is what we're going to be looking at. So this is the operating cycle. The big picture that I showed you is the operating cycle, and the middle part that I showed you is the net operating cycle. So let me just go back and write over here that this whole big picture is your operating cycle, and this smaller part is your net operating cycle, because this earlier part over here, this money is not our money that is getting stuck. It is actually our suppliers' money that we are using, right? So if you subtract that from this is called days payable outstanding, which means how many days of payable are you pulling from your suppliers, right? That's the amount of liquidity you're actually pulling from your suppliers. Now, some companies have a very short operating cycle, which means they can, let's say if it is 15 days, it takes them 15 days to rotate the whole thing around. So you can imagine how many times a year they'll be able to do that, right? And for some companies, it's much more than 15 days, maybe even more than 365 days. Think of Boeing, right? That makes airplanes. Think of companies that makes ships that sail, that are in the water for shipping lines. So it takes a long time to get these products ready and then sold. So they could be much longer operating cycles for some, and for some it can be very, very short. Here's a nice illustration from your curriculum that what is the total source of this operating cycle, that of course you're buying raw materials, converting them to finished goods, selling them on credit and getting your cash, and then the whole cycle repeats again. So these activities of course generate cash outflows when you're purchasing your raw material, cash inflows when you're selling your finished products or services. The raw materials can be purchased on credit, and the payment to your supplier or vendor could be made at a later date. So it's not necessary that the raw materials are purchased on cash or even advanced payment. The finished goods again also not necessary that they are sold on cash. They could be sold on credit where the payment is coming later, right? And of course there might be a certain number of days in which you have finished these goods, you haven't even sold them, so your money is just stuck up in inventory. And now I want you to start thinking of this in terms of some accounting terms. So if you have assets, liabilities and equity in a business, right, there are some assets such as accounts receivable. And what does that mean? It means you have also, some companies write trade receivable, right? So this is basically money that you are going to receive from your clients or your customers. So you've supplied them some goods or services and they haven't paid you yet. So it's an asset for you because, of course, you're going to get money. But this is part of your working capital because this is not your fixed capital. It's not a property, plant, or equipment. This is something that is part of your business. The other type of asset that we need to be looking out for is inventory. So when we are in business, in the course of business, either our money in the short term is getting stuck up in the credit we are extending to our customers or in the inventory that we are maintaining on hand, hoping that we will be able to find customers to sell this inventory to. There is also something known as prepaid assets. Sometimes we make advance payments for certain things in the course of business. So that is considered as an asset because you've paid for something that you will be getting, a service or a good. And since you will be getting some economic benefit from that, it is considered a asset. And usually this is for very, very short term, that the benefit you will be getting within the year. So it is considered a current asset and therefore it is all part of your working capital. On the other hand, the credit that you are getting from your suppliers, which is accounts payable, also sometimes called trade payable, is the money you are pulling, the liquidity you are pulling, the working capital you are pulling from your suppliers. So this, from a liquidity point of view, is a good thing, right? Because this is not your money that is getting stuck up. It is somebody else's money. This is somebody else's account receivable, which is an account payable for you because you have to pay it and they will be receiving it. But this is your supplier because you are their customer, right? So this is your supplier's money that you have pulled into your business. So this should be high. This should be low if you want to have a short conversion cycle. Future cash inflows from operating activities are recorded as short-term assets, such as account receivable will be, of course, resulting into cash inflow when you will receive the payment. Inventory will also turn into cash inflow when you're going to sell that inventory. And of course, future outflows, such as your accounts payable, are considered short-term liabilities because these liabilities have to be paid in the short term, and these assets such as inventory, account receivable, are going to be converted into cash in the short term as well. Current, by the way, when we say short term, usually on the accounting statements we see the word current used, and that is a reference to assets that will be converted into cash within one operating cycle, which is usually 1 year for 1 year or less for most of the companies. But you have examples like Boeing or ship manufacturing companies, which usually take a little bit longer. Right. So now coming to these short-term assets and liabilities, first let's focus on the short-term assets. I already told you about accounts receivable. This is money that you will collect from your customers. You've already delivered the products or services to them, and the remaining collection is still remaining. Or another example of a short term or a current asset is inventory, that this will be converted to cash hopefully within one operating cycle or 1 year, whichever is lesser. And then there should be a gap here because this is short term asset and liability, because these are of course liabilities. These are your assets, the first two. Now, short-term liability, it means here the example is accounts payable, where you have purchased some goods or services from your suppliers and you have to pay for these services. So this is actually a good thing. If this is higher, that means we are pulling working capital from our suppliers from a liquidity perspective. And this is higher, then that is a bad thing because that means a lot of money of our own is getting stuck up in accounts receivable or inventory. Now again, the chart should be separated over here in the middle because this is short-term liability and this is short-term asset. So when is an account receivable recognized? When you sell your goods or services to a customer, but you're selling on credit, which means the payment hasn't been received yet, but the product has been delivered, it has been sold. And when will it be de-recognized? When the payment is received. Now with inventory, when you get your inventory, when you take ownership of the inventory, then you will say, okay, I have this inventory asset. And when that inventory is sold to the customer, then you will de-recognize it. What about accounts payable? Of course, when you receive the product or service from your supplier, then you will record this accounts payable, and when you make the payment to them, then you will de-recognize that accounts payable. So what's going on over here? From the date of the purchase to the date of the payment to your supplier, this is the number of days you are pulling from your supplier. This is called DPO, or days payable outstanding. And this is a good thing, because this money or this number of days you are pulling from your supplier, right? You've gotten the goods, but you haven't made the payment yet. So you are pulling this. Then of course you have this inventory, but you haven't sold it yet. Until you sell it to your customer, you are going to hold this inventory on hand. So we call this days of inventory on hand. Now here you're holding this inventory on hand, you're waiting for the customer to arrive, and technically speaking, of course, your days of inventory on hand, right, it starts from the purchase till you sell them, because you are holding your inventory right from the point where you do purchase it. But as far as our cash conversion cycle is concerned, we're going to count that from the point we are paying for it. So we have to appreciate this delicate difference between the start of the cash conversion cycle and the start of the days inventory on hand, because days inventory on hand technically starts from here where you purchase the inventory, right? But our cash conversion cycle will start from the point where we make the payment. And where will it end? Of course, when you receive your cash from your customer. And this portion over here, which is from here till the end, so this big line is DSO, this line over here is DPO, from here to here is DPO. DSO is of course from one corner to the other, and then you've got this last one, which is the amount of days that it takes for your customer to pay you, and that is called days sales outstanding, or DSO. We will look at the calculation of these in a later learning module in more detail as well. So now the important point is, what is your cash conversion cycle? And let's draw our diagram again, because this is very important, that from your purchase till your cash out till your cash in, right? And somewhere in the middle is your sales, right? So your cash conversion cycle is this part. This is your cash conversion cycle. Now, how do we calculate this cash conversion cycle? First of all, you take your days inventory on hand, days inventory on hand. But we don't want this part, right, which is your days payable outstanding, which is the amount of days you're pulling from your supplier. So we will take the days of inventory on hand and we will minus the days payable outstanding, so that we are able to get this portion. And then for the remaining portion, which is your days sales outstanding, from your sales till your cash collection, that's why we just add the days sales outstanding. And this is how you get your cash conversion cycle. And this is the diagram that I have been drawing for you, and now you see it. It is of course coming from your curriculum, from receiving the inventory from your suppliers till the inventory is sold to the customers. This is your days inventory on hand. And we do subtract from that the days payable outstanding, because that is where our cash conversion cycle will begin from, where our cash out is. And we also add to that. So this part is the DOH minus the DPO, right? Which gives us this portion, because DOH is the whole thing minus the DPO will give us this portion. And then we have to add back also the DSO, which is your days sale outstanding. And that is how we get our cash conversion cycle. Now, generally, the rule is shorter is better, right? Which means less money stuck up in inventory, less money stuck up in accounts receivable, and more money pulled from your suppliers. So technically, that is the better option from an analyst's perspective, from an investor's perspective. We don't want a company which is having too much money stuck up in either inventory or accounts receivable, because that means they are converting their cash very slowly and a lot of money is being stuck up in working capital. And what could be an opposite situation, and think of companies like Walmart or Target or Costco if you're from the US, or think of Sainsbury's or Waitrose if you're from the UK, right? All these Tesco, all these chains. If you're from Germany, think of Asda and Spar. If you're from India, think of Reliance Mart, right? And so many. If you're from France, you've got Carrefour, Jean. So many different examples you can have. And why am I giving you retail examples? Because what these guys do is that they take cash upfront from their customers, right? As soon as the customer comes in, they pay cash, right? Whether they are using a debit card or credit card, doesn't matter. These guys get cash up front. And to the suppliers, they're probably not going to pay for a number of days. So their DPO is going to be very high, the number of days they are pulling from their supplier, and their customer is paying them up front. They don't even give any credit, hardly any credit to their customers. So they could actually have a negative cash conversion cycle, that they are financing their business from the customer's money and not paying to the suppliers. So this is also possible. Okay, so let's have a look at this example. And I would rather request you to pause the video and try to solve this yourself, and then I will show you the solution. So please pause the video and try to solve this yourself and tell me which company has the shortest cash conversion cycle. All right, so hopefully you were able to get an answer here, and the answer is Target, because if you see, Target has a DPO of 75 days, right, which is the amount of money they're pulling from their suppliers. Their inventory is 68, and their days sales outstanding is 2 days. So actually they have a negative cash conversion cycle of -5 days, which is fantastic, right? And they therefore have the shortest or most efficient cash conversion cycle. Now, how does a company go about doing this? How can they shorten their cash conversion cycle? And this is very, very straightforward. Reduce the number of inventory days that you have, right? Don't keep inventory unnecessarily. The Japanese are very good at this, by the way. They have something called just in time. And they've got all these different wonderful terms called Kaizen and Kanban. And so Toyota and Honda and all these companies are very, very good at maintaining low inventory days. They keep just-in-time inventory, which means they only ask their suppliers to deliver it when the customer needs it. Of course, don't give too much credit, so reduce your days sales outstanding and try and pull as much credit from your suppliers. Now, I want to talk about this a little bit. See, theoretically, technically, yes, it's very good that you should pull as much money you can from your suppliers. But practically speaking, you have to understand that they are also in business with you. You are their customer, they are your supplier, and you want a good, stable, long term relationship. You don't want to spoil that relationship, number one, right? Especially if they are a sole supplier of some specialized critical component. And even more importantly than that is, if you are nice to them, if you pay them earlier, maybe they can give you better prices, right? And that is what I want to show you over here, that how good is a discount, right? How do you quantify that discount in terms of annual opportunity cost of money, right? Because you could take a loan from the bank and pay your supplier earlier, but then you as an analyst need to know how to take that discount which your supplier is offering and compare it to the interest rate which the bank is asking you, right? So let's say there is a supplier which says 210 net 30. Now what does this 210 net 30 means? It means they will give you a 2% discount if you pay within 10 days. You have to pay within 30 days anyways. That's the normal account payable that you have to pay within 30 days anyways. But if you pay 20 days earlier, instead of 30, you pay within 10 days. So actually you're just paying 20 days earlier. So you have to take a loan from the bank only for this 20 days, right? And you have to pay interest only on that 20 days. So if you do take this loan, you will get this 2% discount. Now the question is, what is the interest that you have to pay for that 20 days loan, and what is this 2% compared to that? So we will obviously have to annualize this 2% and then compare it to the annual rate of interest, because banks always quote interest rate annually. And this is the formula for converting that discount into an annualized number. Now, first of all, let's start understanding this formula from the middle where it says discount. And let's say we are getting a discount of 2%. So that is 0.02. Now we are going to compare this to the amount of money that we have to pay. Now, since we are getting a discount, we're not going to be paying 100% of the amount that we have to pay. We are going to be paying 98% of that. So this 0.02, we're going to see it as a percentage of the 98% that we have to pay, or 1 minus the discount, right? And then we have to annualize this discount that we are getting. Now, how do we annualize it? We don't just multiply it with, one way of doing it would be very simply 0.02 divided by 1 minus 0.98, or 1 minus 0.2 multiplied by 365 divided by the number of days. Let's say it's 20 days that we are going to have to get extra money for. So one way of annualizing is like this. More efficient way of doing it is putting it to the power of 365 over 20. But we can't do it like that without adding 1. So we have to add 1, and then later we have to subtract 1 whenever we annualize it by putting it to the power of. So that's what's going on in this formula. You take the discount, you divide it by the amount of money you will be paying, which is 1 minus the discount. You have to add 1 before annualizing in this way by putting it to the power of 365 divided by the number of days that you will be paying extra, right? And how do you calculate that number of days? So if it's 210 net 30, then you have to pay in 30 days anyways. Now you're paying just within 10 days. So extra days that you are paying earlier is 20 days earlier you are paying. So the loan you will have to need is for that 20 days. And that is what you do, and calculate the percentage, the annualized percentage of the benefit of this discount, and then you compare it to the bank rate. And if this is more, of course, you will take the loan from the bank and get the discount. Now, just to make sure the concept is clear for you, we've got a question. And in case you have forgotten the formula, I've just put it there for you as well. So please pause the video and tell me which option will you go for. All right, so hopefully you got the correct answer, that first of all, what is the annualized percentage of this discount. The discount is 0.02, right, divided by 1 minus 0.02, which is basically 0.98. And let's annualize this. So let's annualize this, and then that will be 365 divided by 20, and then we'll just do minus 1, and what we get is 44.6%. And this is obviously much more than the rate that the bank is asking for, and therefore, right, we will borrow from the bank and pay the supplier early to avail this discount. All right, so that is it for this concept. Now let's talk about total working capital versus net working capital. See, when you are getting your money stuck up in accounts receivable, when you are getting your money stuck up in inventory, when you are getting your money stuck up in prepaid expenses, right, that is not a good thing, because this is your investors' money which is being stuck up in the course of business. However, if you are pulling money from your suppliers, that is a good thing, because you're using other people's investment for doing your business. So from an investment perspective, what we want to see is a low total working capital and a low total net working capital. Now the only difference here is that we take your current assets and we exclude cash and marketable securities, because it is possible that a company might be having current assets, but they are not account receivable, they are not inventory, they are not prepaid expenses. What they are is cash and investments in bonds or stocks, right, marketable securities, which is not related to your business. So that is why when we calculate net working capital, instead of taking all of the current assets, we only take the good ones, which is AR, inventory. Well, when I say good ones, what I mean is the ones related to trade and business, and we exclude cash and marketable securities. And similarly, on the current liabilities, you might have some bank loan, which could be in both short term and long term. So short term bank loan we will not take when we are calculating net working capital, because that is not related to trade, that is just a financing thing. And the current portion of the long term loan, so bank loan is short term and long term both, but as far as current liabilities is concerned, which is the liabilities that has to be paid within 1 year, of course short term is going to be all current, but long term loans will not be current, but there will be a current portion of that long term which has to be paid within the year, and that will be showing as current liability as well. But we will exclude that because we want to focus on the trade related liabilities and the trade related current assets. Now generally speaking, the lower the better, right, the lower the better, but it depends on which industry you are in. Some industries have high working capital requirements, some industries have low working capital requirements. So therefore, to be able to compare if this ratio is good or not, it is usually seen, number one, compared to the industry average. So if a certain company is having a decent, efficient situation or not, we have to compare it to its industry average, number one. Number two, it is also seen as a percentage of sales. It's not just seen in absolute terms that, okay, a $500 million net working capital, is that a good thing or a bad thing? Well, you cannot say. It depends on the size of the company, depends on the size of their sales. So this is seen as a percentage of sales, and of course, the lower the better. But then again, you should compare it to the industry average and see that on average, the companies in that industry, what is their net working capital as a percentage of sales, and how is this particular company that you are monitoring, how is it doing? Right. So before we close our discussion on cash conversion cycle, there is a question for you from the curriculum, question number 6. And what I would like to request you is that please calculate the net working capital. I'll just help you out a little bit. That on the asset side, we're not going to be taking cash because we're talking about net working capital. So cash and marketable securities we will not be taking. We'll only be taking the ones which are related to your business. And fixed capital, of course, we will not be taking, or intangibles, which are like your copyright, your brand, assets which you can't touch. They are not tangibles, they are intangibles, but again, we will not be taking those on the asset side. And as far as current liabilities are concerned, these two, of course, we will be taking because that is related to trade. But short-term debt and long-term debt we will not be taking, and neither will we be taking the equity. So this is your current assets for your net working capital requirement and your current liabilities. Please tell me, what is the net working capital? So hopefully you were able to get 380, which is basically 1430 minus 1050. And that is it for your cash conversion cycle. We're going to stop the video here, and in the next video we will pick it up from liquidity.